A very good evening to you all, friends. I'm Sanjeev Singhal, Chairman of the Auditing and Assurance Standard Board and Chairman Sustainability Reporting Standard Board of the Institute of Chartered Accountant of India. On behalf of ICI, Auditing and Assurance Standard Board, my own behalf, and on behalf of my Vice Chairman, CA Vishal Doshi, I welcome you all to the 79th webinar of League Seminar of the AASB for this council year. Today's topic is risk assessment and responses to assessed risk. Friends, this is very important topic because as an auditor, while planning the audit, you have to assess the risk, that what is the inherent risk, what is the overall risk in the audit engagement, because risk will define your sample size, risk will define the level of the planning materiality, tolerable error, and the SAD, summary of audit differences. Risk will also define what are the areas on which you have to focus, whether you have to apply a control-based testing or a substantive testing, and how do you respond to those risks in the form of testing, sampling, or and anything else. So this is extremely important that that risk has been factored in, because if that has not been done, then the reporting results may also not be appropriate. At times, the risk could be so high that the auditor may decide that they will not accept this engagement. And to deal with this topic today, we have our technical speaker, CA Rikin Bagaria, who have more than 12 years of post-qualification experience in auditing small to large listed and unlisted corporates, as a chartered accountant and company secretary. And friends, this has been our endeavor to take the auditing standard learning to the doorstep of every member. And that is why we have been organizing program on various topics within the auditing field. So far, we have organized a program on each of the auditing standard, on Schedule 3 and CARO, each line item of the balance sheet and profit and loss account. And now we are taking up specialized item, for example, the topic for discussion for today. And we have also launched an expert panel, which is answering the queries of the member pertaining to audit of the corporates as well as audit of non-corporates. We have 50 experts in this panel, which are answering the queries of the member free of cost, and we have received an overwhelming response for the same. The idea is to improve audit quality and help member consult when they are faced with a difficult situation or a situation which warrants a consultation. But please note that this is only in respect of the auditing matters. And friends, I have the great pleasure of introducing my elder brother in the council, third term council member, CA Sushil Bhai Goel from Eastern region. And Sushil Bhai is known for his being soft-spoken and yet determined and firm, hard task master. This time is the chairman of the Student Skill Enrichment Board. And we have seen the passion with which he is running this board, the manner in which the practical classes are being held every week, the manner in which the national conference is being happening, the manner in which the GMCS and ITT have been turned around. And Sushil Bhai is also known as a GST man. He has been the chairman of the Indirect Tax Committee. Besides serving the Central Council, he's been a regional council member and also the chairman of the Regional Council. His target is always to beat and exceed the set milestone. And that's what all the council members at the Institute of Chartered Accountant of India aim at, because we must benchmark ourselves so high that it sets benchmark for others. Sushil Bhai has been a presiding officer at the Board of Discipline. He's been a member of exam committee for 3 years. He has also been a chairman of Board of Studies Academics. So he's been on both sides, academics as well as the Student Skill Enrichment Board. And he's also leading a very noble initiative of implementing the National Call Center for ICI, which will improve the image of the Institute of Chartered Accountant of India so well, because once the call center is fully operational, members and students' queries will be handled, most of the queries through that call center, and the regular complaint of the members and students that no one picks up the call will be thing of the past. He's also launched the job portal for CAs to increase their convenience for generating opportunities, and he has represented ICI at Open Forum of World Customs Organization. Uh, he's a regular trainer, and he has contributed many articles. And I regularly receive his GST tips. Of course, I'm not a GST expert, but I get GST tips, and more than 1,750 tips, to the best of my knowledge, have been shared so far. And quite unassuming personality, smiling, soft spoken. It will always feel that he's always available for everyone, and he is. So thank you, Sushil Bhai, for being there. And I request you to kindly address the members.
Thank you, Sanjeev Bhai. Nice initiative, and spoken so much words about me. I'm now feeling responsible that I have to uh, deliver all whatever Sanjeev Bhai has said, even if I'm not delivering all this. But you can say the great work Sanjeev Bhai has taken, because our profession largely in auditing, and being the chairman of Audit Assurance Standard Board, uh, doing so many. And this is 79th program. I am myself is surprised to know this, and almost benefited the lakh viewer. And that is great achievement. And by the year end, when he will going to end his tenure this year, I think this post is longer period. But this year, when he's going to end, he will be somewhere 150 program, and by the time must the delegate participant will be 2 lakh. Today he is dealing with SA 315 and 330. That is the risk assessment. That is the most important part of the audit assignment, which I can understand, because being a presiding officer in Board of Discipline, I found that a few of the members sometimes think that their client will support them during the difficult time, or when some notice will be received from any government agency or institute, but it is not happening. So never try to support your client. Do your work, do your documentation. That is going to support you. And largely, what I have seen, when we receive the complaints, we have seen there are dispute between the stakeholders in the organization. Some partners are fighting, directors are fighting, and ultimately they try to nail the chartered accountant, because chartered accountant either going to one of these director or partner, then other want to take revenge by filing disciplinary cases against the members. So if you are doing proper risk assessment, doing the documentation, we can take care of this type of situations, because sometimes we feel that we will approachable to the client, we are regularly visiting the client in documentation, try to take copy of that and keep in anytime we can take. So please do not think that. Take the document, complete the documentation as if it is the last day of your client. Though I'm not miss so, but doing the risk assessment, this is the most advisable things from me over the past 6.5 years, what I gathered being in the corridor of ICI as a Central Council member. I just want to salute Sanjeev Bhai. He is a man. He is not only expert of the auditing, but he is the expert of the sustainability in the country. Yesterday only I received a call from this organization team from World Congress, which is we are going to host in November. And this person only told me that we have to buy a certain kit for our delegates, and that must be sustainable. So look for some cloth-made kits or jute-made kits. We cannot afford to ignore Sanjeev Bhai's vision, missions, and target. But ICI should be totally doing programs keeping in mind sustainability, because if we do not give the better environment to our future generation, we will not be held our head high when we will have to answer all this. So thank you, Sanjeev Bhai, keeping in mind, doing great things, so many things. If I start telling everything what Sanjeev Bhai is doing in the ICI, this SRO now, newly formed SRO, social audit. I think by the time all the viewers are aware about this. So thank you, Sanjeev Bhai. Thank you, all the viewers. Keep on watching. And last but not the least, that is the Rikin Ji who is going to take today's topic. And I have no doubt that the entire participant going to enjoy your session. Thank you.
Thank you.
Thank you, Sushil bhai. And Rikin, I can see the background theme is creativity. So you have to
Yeah,
be creative to catch the frauds and address the risk, not the
correct.
other way around. So that's the message that we should give to the
Yeah,
members. So Rikin,
correct.
screen is all yours. Please
Yeah,
go ahead.
thank you. Is it visible?
Yes, sir. Fine, sir.
Yeah. Okay. Uh, Good evening, everyone. I am Rikin Bagaria, as introduced by Mr. Sushil sir and Sanjeev sir. I have worked in auditing field for more than 12 years and done small to large corporate listed, unlisted companies in my career. Today, I'll be taking you through about the risk assessment procedures and what are the responses what we have to give once we identify and assess the risk. So both these standards are governed by section SA 315 and SA 330. There is a very famous quote from Warren Buffett. Risk comes from not knowing what you are doing. So it's very important if you are doing any audit, it is important that you know what is the risk in the audit engagement, how do you mitigate the risk, and how do you reduce it to the acceptably low level so that you don't give incorrect audit opinion. So before we jump on to risk assessment standard, I'll just throw some light over some of the regulatory review comments from NFRA, uh, from QRB. They have pointed out this point on the risk assessment and SA 330 both, that audit firms have been failed to appropriately deal with the identification, categorization, minimization of the engagement risk. So this as you can see the highlighted portion, the misstatement due to fraud was ruled out by the audit firm. So these are the kind of comments regulatory reviews uh, have, and it's impacting our reputation in the market, whatever reputation we have as an auditor, by not applying the standard in the true spirit. So there is another comment on inadequate and improper evaluation of risk of material misstatements. There is another comment on not following the risk assessment in the beginning to include analytical procedures. There is another comment saying there was a RBI inspection report available at the beginning of the audit, but it was not considered in the risk assessment procedure for the very important or high risk issues which were noted in that inspection report. There was another comment on going concern assessment was not properly documented, which is required by SA 315 to at least assess whether there are any events or conditions that cast doubt on the entity's ability to continue as going concern. Then there was a comment on firm failed to perform risk assessment procedure. This fraud risk internal control checklist were merely just yes no response, and it was created towards the end of the audit instead of at the beginning of the audit. So the point here is, although these are from NFRA or QRB applicable for large engagements, because NFRA rules or QRB applicability applies to only uh, clients where certain threshold is crossed. However, standards are standards. So SC 315 is applicable for all the entities. There is no exemption around that. So we have to follow this in all the means, irrespective whether it is a large company or a small company or a medium-sized company. Yeah, so there is one more comment that entire risk assessment procedure was unsatisfactory. So to receive such comment is really problematic for all the firms. So it creates a lot of trouble, and to get out of this is really challenging. Okay, coming to the scope, understanding, and objectives of risk assessment in audit. So before I go to that, I'll just summarize the agenda, what all things we'll be covering in today's session, so that you guys are clear about the flow. So first we'll be discussing about the scope, understanding, and objectives of risk assessment. Then we'll discuss about the risk assessment procedures. What are the types of risk assessment procedures? And then in that there are subsections. So for each type of risk assessment procedure, there is a separate slide where I'll be talking about each aspect of the risk assessment procedure. We'll touch upon the significant risk due to fraud, errors. We'll also discuss about the how after doing all the risk assessment, what discussion you as a team, engagement team, need to have. And then we'll cover about the SA 330 scope and objective, where I'll be taking you through the audit responses, what we have to give to the identified and assessed risk. Yeah, so starting with the scope, understanding, and objectives of risk assessment. So this standard deals with how to identify and assess risk of material misstatement in the financial statement. This is done through understanding of the entity and its environment. It also includes understanding of entity's internal control. So we'll go through each and every aspect one by one. So what is the overall objective of the auditor? So first, you should understand the entity you are auditing, then identify and assess risk of material misstatement through entity's environment and internal controls. Do this at a financial statement, at an overall financial statement level, what could go wrong. At an individual caption level, account balance level, also assess what could go wrong. So this is the heart of the audit. Like before starting the audit, we have to do this risk assessment, and then you design and implement. You plan the responses what you have to give to this risk. So by doing this, you will reduce the entire risk applicable to the audit to the acceptably low level, and then there won't be any problem in issuing the clean opinion to the company. So yeah, before we go into entities understanding and its environment, it's important that you understand the basic terms of audit risk. Audit risk includes three types of risk: inherent risk, control risk, and detection risk. Inherent risk is something which is uncontrollable in nature for management or company to identify or control, right? So this kind of risk will always remain in some of the industry. Like there can be technology industry where technical obsolescence can lead to a significant issues. There can be a company where there's a huge element of cash in a normal manner, but then it creates an inherent risk. In FS sector, financial services, there can be complex derivatives, which is very inherent. There are a lot of regulations applicable to FS companies where it's quite challenging. Okay. Control risk is something where management and employees have been able. So controls are developed just to mitigate business risk, process risk, whatever company would have developed. So that is to prevent misstatements that can occur in the financial statement. And the detection risk is something that auditor, by doing a sampling or not designing an audit program properly, or not following a risk assessment procedure, or auditing less than what is required, then there is always a detection risk. So inherent risk and control risk are something where auditor needs to assess and test. Detection risk is something within the audit team. They have to minimize the detection risk so that the overall risk remains at a low level. Okay, what are the type of audit procedures applicable in any audit? So there are risk assessment procedures, which we'll be talking about today. There are other procedures, test of controls, substantive procedures. Substantive procedures include further test of details, which is vouching or balance verification, and analytical procedure. Substantive analytical procedure is also a part of substantive procedure. So both these procedures, risk assessment procedures and other procedures, we'll be talking about in today's session. So what are the types of risk assessment procedures? So you would have experienced all this in some of your audit, and for people for whom this is new, it will be interesting to know at least the basics of risk assessment procedure. So you have to understand from the entity, understand the entity and its environment. That's one of the risk assessment procedure you have to do. By understanding, you will come to know a lot of factors which can lead to a risk of material misstatement. We'll talk about that. You can perform inquiries with management, employees, you can read the board minutes of meeting, you can read the audit committee minutes of meeting, can you need to do inquiries with internal audit function of the company, information what is available from the client acceptance or continuation process, whatever background check you would have done about the client before accepting it. You can do a analytical procedure at the planning stage when you have a draft or trial balance or a planning numbers. Then it is important that you perform analytical procedures. Also, you can, if it's a existing engagement you are doing for the second or third year, information from the previous engagement experience, audits, significant changes that would have occurred, that can give you some indication of what can be risk of material mistake. Now we'll talk about each of this procedure in detail one by one, so that you guys have a feel about what all things are very important, how you can do it, and how you can document also in the file. So first is on the entity and its environment. So as you can see, first thing is industry, regulator, and external factors you should assess. Now, you need to understand at the beginning of the audit that which industry the company belongs to. Is it a high risk industry? Is it into real estate business? It's into internet gaming or infrastructure business? Because of the COVID, is there any effect on such sector like hotel, uh, tourism business, entertainment? So this kind of understanding of the industry which belongs to gives a perspective that what are the risks can be applicable to this industry, because there is a whole knowledge available about the industry. When you Google it or do internet search, you type the industry name, you will get the information about it, what all industry risks currently are faced. So it's quite important to understand what is the industry the company is operating, what are the regulatory regulations applicable to the company. If it's a bank, there are many regulations applicable and quite complex ones. If it's a real estate, so RERA is applicable. So you have to understand what are the laws and regulations applicable to the company. Is there anything which warrants more focus from any regulatory changes or regulatory factors applicable? What are the external factors that also you should assess? Something like COVID was considered to be external factors, like that impacted many industries, benefited also in some of the industries like pharma. However, a lot of sectors got impacted because of the COVID. There can be supply issues in a particular industry, which can be an external factor. Like we have seen in some of the companies, the commodity prices have shot up because China was only the supplying country and there was a huge shortage of raw material. So this kind of external factors also you have to keep in mind while you are doing understanding of the entity. You also have to understand the nature of the entity. How, what are the objectives of the entity, how it is structured, who are the shareholders, who are the ultimate parent company, who owns that, how it is financed. Is it financed internally by the promoters or any foreign company? Is it financed through banks, working capital loans, term loans? How much? So all this understanding is quite relevant to know what all risk can be applicable to the entity. You also need to understand the investments, where the company has made investments. Are there any is there any complex structure in which company is operating? Are there multiple layers in the investment? Are those companies really performing well? Are they companies into are these companies are into profitability? No impairment evaluation is required. Net worth is strong. We need to assess if it's a 50-50% joint venture, then what are the risks applicable to such industry? Yeah. So we also need to understand the objectives of the entity, where what are the business risks, what they see in the business. Not all business risks will lead to a material misstatement. However, whatever business risks which can lead to material misstatement in the financial statement, we should be careful about it to consider. We also should understand the accounting policies applicable to the company. So now this is very interesting. So so most of the time, so if it's a large company, there is a chance that all the accounting standards are applicable, and some of the standards are very complex. So how company has selected the accounting positions, if there are judgments involved, are they applying the judgments consistently, appropriate accounting policies have been followed. So this, and the financial reporting framework is properly followed. So recently Schedule 3 CARO 2020 has also got changed. Whether the Schedule 3 requirements have been consistently applied by the company in a particular year or not. Because so in March 22, March 21 comparative was also required to be restated. So there, I mean, a lot of evaluation was required to be done. This can also raise a particular risk, because one of the requirement of Schedule 3 was to submit the information about what was the stock amount in the books and what was the stock amount as per the submissions made to the banks. So this require a lot of efforts from the company side to apply the accounting policies correctly. Then also we should see the how the management reviews the performance. What are the forecasts prepared by the company? What are the actuals against those forecasts? Is there any significant deviations? If there are significant deviation, then we should capture that in our risk assessment procedure, that what can be the risk because of forecast not being achieved. Okay, so we discussed about how to understand the entity and its environment. Then what is important, how we link this to the risk of material misstatement. Now there's a example in front of you where there is a shortage of supply for companies raw material, as key supplier not being able to fulfill the order. This could increase the risk that company may not meet its revenue targets if there is no alternative supplier. Now, what risk this can pose? So, since the key supplier is not available, there is no alternative supplier. Company will have set revenue targets to achieve. Now, this can lead or pressurize management to do a fraudulent activity in the revenues so that they can meet the investors. Now, I'm not saying that this has happened, but at the beginning of the audit, if there are such scenario, we have to have a risk of material misstatement due to fraud, which can happen in revenues. Okay, because there is a condition, there is a situation where this can lead to a risk of fraud. So therefore, we need to be cautious at the beginning of the audit, that we apply our audit procedures more carefully, because fraud risk requires special consideration. There are additional steps to be followed other than the routine test of controls and test of details. So this need to be kept in mind. If you face such scenario during your understanding of the environment, just be careful. This is I'm just showing you this example just to make you guys alert. If you face such situation, you need to be alert about this, and it should click in your mind that what it can impact in the financial reporting, and whether this risk can be a very significant risk due to error or a fraud. If there are changes in the existing trade and customs, or company started selling products in a new country, the different trade and custom regulation, this may present new requirements and risk for the company. So now what is this situation leading to, or risk? So since the company is entering into a new country with a very different unknown trade and custom regulation, there is a chance that inadvertently also company may misapply the regulation because it's an unknown country. Illegal act may happen. So this may potentially lead to a contingent liability. So in our risk of material misstatement, we should consider this as a RMM which can lead to a contingent liability situation. Now, gathering all the information, understanding is quite simple one. So it's just that recording this information and linking to the account balance and the assertion level or the financial statement level, that's where the challenge comes, because the regulatory reviews are also commenting that people would have done the procedures, but it's not part of their documentation. It's not properly and systematically flowing in the audit files. So there we need to really work upon that, how best we can get whatever information has been gathered, we link it to all the account balances, assertions applicable, and we have a proper risk assessment made in the file, and then we can have an appropriate plan. So by doing this risk assessment, basis my experience, I'm telling you that 60% of your audit work will be done. It's just if you have done your risk assessment and planning for responses very well, 60% of your audit will be done. Then it is just the execution, unless some or the other new event or new condition comes later on during execution of audit. That time you might have to change the risk assessment procedures. However, it's quite possible that if you plan it well, you will not have very much problem in the later time. There's some more example. So entity have multiple revenue streams with significant variable consideration. Now, if there are various incentive schemes in the revenue, if there are multiple performance obligation, then timing and extent of revenue may not be appropriate, can be a risk of material misstatement. There is a condition where analyst has, so by reading the analyst report on a company, they have reduced the stock price due to entity not meeting revenue targets. So this may create pressure on the entity that revenue recognition may be inflated. So we need to be careful about this risk. Entity has expanded rapidly without certainty over long-term demand for entity's product. So valuation of inventory can be challenging because if the company has expanded rapidly without thinking how it is going to be sustainable over long term, then this can create a inventory valuation risk, and it may have a situation later on that it might be sold at a loss. We need to define that as a risk of material misstatement. Any goodwill or deferred tax asset, whatever would have been created as a part of expansion, or tangible assets, that also may lead to a impairment situation later on. Revenue and trade receivables may be seem to be moving in a opposite direction. So if trade receivables are increasing significantly, then what is revenue recorded, or the DSOs, the day sales overdues, are increased, then there is a possibility that you might not be able to assess the expected credit loss properly in the entity, and therefore you should define this as a risk of material misstatement. Tone at the top, the entity may not lay down such a procedure that emphasizes on internal control. There is not a disciplined internal control environment. Then it can have a very pervasive effect, because if the entity level controls, the controls operated by the senior management team of the company, is not focusing or emphasizing on strong control environment, then it can really have a pervasive effect, and we can't really follow controls approach in such situation. Okay. So next is on the, and so we discuss about understanding of entity and its environment. We discuss about the examples around that. Now we are going to a planning analytical procedure. So this is also one of the very important step. NFRA has also questioned on this. This has not been done at the beginning of the audit, rather towards the end of the audit, final numbers have been uh, analytically reviewed. So this is one of the very important step as a part of risk assessment procedure. In this stage, you get a draft trial balance or a financial statement from the company. You will have some previous audited numbers, should compare, uh, should develop a relationship. If you should also calculate ratios, trends, what the competitor company is doing here, what are the competitor margins, are there any unusual transaction which is not seen in the past 2 years, 3 years. So these kind of things will help you in determining the risk, what can be possible risk of material mistake. If the company has a set pattern of earning 10% margin every year, but suddenly it has dropped to 5%, or it has increased to 15%. So we need to know whether the cost, so revenue is properly recognized, or the cost is appropriately recognized or not, in case the margins have gone up. Analytical procedures over revenue accounts are also critical, because revenue being a presumed fraud risk area under SA 240, it's quite important that and necessitated by SA 240 that you need to perform an analytical procedure at the planning stage. These are the kind of revenue analytical procedures you should perform in your audit. What are the product lines? What are the divisions applicable? Location? You should compare the revenue by such means. You should also analyze the key ratios such as debtors turnover ratio, gross margin, or inventory turnover ratio. Also analyze the trends over historical period, how monthly or quarterly. Is there a trend that last 7 days of a month company has a short up sales in a particular March month, and not all the months of the year. This kind of situation will give you indication of the risk that can be there in a particular account. So as I explained, in a March month, in last 7 days, the sales have almost sales of that month was 190% of the sales was in last 7 days. And in we checked April to February period as well. That was not the scene. So in that situation, there is surely a cutoff risk which we should be careful in our audit procedures. Okay. So yeah, these are the techniques. These are the steps. Develop the expectation based on the results of other risk assessment procedure. If you have identified some of the numbers like competitor margin is 20% and the company is earning 15%, just ask questions to company that why it's not in the line of competitor. What are the different things applicable to the company? There can be genuine reasons for that. However, we should ask the question because assuming will not be correct way of approaching. Rather, since you are compared with the competitor margins, should have an answer from the company side to understand the reason for difference. Compare the expectation with actual amounts. So how company budgeted or there is a revised budget also applicable in the company. What are those differences and why? How company explain those reasons? Just by understanding those reasons, you will be coming to know what can be the risk applicable to the company. Inquire the management to understand the reason and identify that can uh, lead to a specific risk. So just yeah, so we do a comparison in planning analytical, but that's not the whole objective of planning analytical procedure. So simply doing comparison of current period with vis-a-vis previous period or last 2 years is not only thing which we should do. That is one of the thing of planning analytical procedure that will give you the significant variance. What are the reason for that? You'll be able to come to know some of the things. However, that's not the only thing. You should do more procedures like competitor trend analysis, how the industry is performing, what are the industry ratios applicable, uh, and how it compares with the with your own entities ratios. What are the debt covenant ratios? What banks are looking at it? Are there so yeah, so there is one example around this. Uh, the cost of goods sold and selling and distribution expense have increased by 20%, and this has come to know by doing a planning analytical procedure. Now, uh, at the same time, the trade accounts and accounts payable and accrued expenses have increased by only 10%. So there can be genuine reason about it if the company has made a purchases or incurred the selling and distribution expenses in the first half of the year and it's all been paid. There can be a situation of lesser increase in trade payable and accrued expenses. However, this is a trigger. We should at least assess, discuss with the company, are there any risk that liabilities or cost is not properly accrued. Okay. So these are the good examples. What all planning and analytical procedures you can perform. Timing of debt repayments as the company really uh, on time to repay their debts. Are they borrowing more and more or refinancing, or actually there is a outflow happening to the banks? also assess expected ability to make the repayments, whether they will be able to generate proper cash flows to make the required repayments. Risk of breach of covenants. So there can be multiple banks involved in financing the company. There are multiple agreements. Should see how company is complying with the uh, covenants. Are there any situation of breach of covenants? If there are, then what are the implication? Is there any penalty in terms of interest rate, or whether company's long-term loan can be recalled? And you might need to see a classification risk of being it current instead of non-current liability. We discuss about actual performance versus forecast. Then we should also ask company to know, because all the company will be going for a credit rating. What was the credit rating of the company? Is it downward? Is it going down or improving? This can also help us to understand more reasons why this is so. What are the issues? What was the so when you look at the credit rating report, there will be reasons written also about the rating provided. If receivables are growing faster than revenues, we discussed about that. If the profitability ratios, the debt equity ratio, debt service coverage ratio are not in line with earlier years or not in line with the industry trend, it should trigger more procedures to be performed around risk. Unusually high price earning ratios for industries then their competitive can also be important to consider. So we should also link, if the revenue is recognized, how much cash flows are actually generated from the revenue. So this can also help us to understand how fast they are able to collect. We should do all this ratio analysis. Schedule 3 has now have a long list of ratios applicable, and those are really helpful. It serves the dual purpose, and this can be used as a part of risk assessment procedure as well. Okay. Now, next is so we discuss entity and its environment, then planning analytical procedures. Now we are coming to the inquiries with those charged with governance, management, and others. So, if it's a large listed company, there will be audit committee with independent directors on the board, executive directors on the board. So, for we should at least meet uh, in our audit before we start executing the audit. It is very important that we come up with a standard set of questions which is available in the implementation guide issued by ICI on risk based audit. There are many checklists available in the Google as well. So even SA 315 application material has already list of question we should ask. So these kind of questions will help us to understand how people at audit committee level are looking at the entity's risk. What are the how they are controlling the frauds, how they are ensuring that there won't be any fraud in the entity. So this kind of high level inquiries will certainly help in identifying if there are any risks to consider in our audit. Are these inquiries really sufficient enough that gives a confidence to us as a part of the audit that yes, there's a oversight body who is very systematically looking after all the cases. Or if it is not satisfactory, then it can lead to a major risk. It can lead to a more significant risk that you will identify in a audit. Have inquiries with management, CFO, CEOs of the company. Have inquiry with employees, marketing personnel also, to understand what are the business strategies, what are the products we are into, what are the new products they are going to launch. Are there any new countries they are planning to go? So This will also help in understanding the business part of the company more, and some of the inquiries will help you in identifying some trigger or scenarios to lead to a risk of material misstatement, which you should consider in your audit. Should also identify in-house legal counsel applicable to the company. So how you can do that? Just go through the legal and professional expense of the company. Identify who are the legal counsels to whom payments have been made. Just send out independent confirmations to them. Follow for the confirmations. What are the laws and what are the legal cases those counsel are handling. This will give you some external evidences that you might not come to know during execution of the audit, rather at the beginning of the audit only you will come to know. Should also hold a inquiry meeting with legal counsel if they are handling any particular big cases very significant to the financial statement. Should try and do an inquiry. This will help in understanding how company is positioning in that litigation. Is there any high risk? By doing that inquiry only, you will come to know and will gain more confidence that is there something where you have to focus more. Inquiries with internal audit function is also quite critical. So you should hold an inquiry meeting along with internal auditors, how they are uh, seeing this company, how they, what all fraud procedures they are following to mitigate the internal audit risk. What are their observations? How the company is reacting to those observations? Have they been able to provide sufficient responses? Are the management very positive about internal audit observation? And uh, this understanding will really help in understanding the risk applicable to the company. There can be legal non-compliance is also identified by internal auditors. See the implication. Is there any significant penalty applicable because of such legal non-compliances? So in your audit, you might not be able to see all the laws and regulation applicable to the company, but these are the means. The internal auditors, company legal counsel, they might be tracking all this on day-to-day basis or as per their scope. So just by doing inquiry procedures, reviewing the internal audit reports, you'll come to know some more risk than what you could have identified on a standalone basis. You should also read the minutes of meeting with the board members, minutes of meeting of audit committee members, remuneration committee. All this thing will really help you to understand, is there any unusual transaction happening, any unauthorized transaction have happened, or something about the performance they would have discussed, uh, whether there are people who are authorized to whom the authorities have been given to make an investment decisions. If company has made some investment decision, you will come to know from the board meeting, because such huge events in the company has to be minuted and will be part of the board meeting. So this, all these documents really help at the beginning of the audit to read and apply those to identify, assess risk, and ultimately linking it to a financial statement level. Okay. Now, so we discuss about entity and its environment, planning analytical procedures, inquiries with management, those charged with governance, others, internal audit function. Now we are coming to understanding the internal controls of the entity. Now, this is quite crucial. So here at this stage, you have to do a full understanding about the company's control environment. What are the controls in place at an entity level as well as business process level? So what are the difference between business entity level and business process level? So entity level controls are controls that operate at an entity level, which are operated by senior management of the company. So there's a difference. Business process controls are process controls like purchase control, sales control, treasury controls. These are the transaction level controls, wherein as a part of the process, you will understand the entire purchase process, sales process, and you will identify the what could go wrong in these processes. And against those what could go wrong, what are the relevant controls in place by the company. So these are the process level controls. However, above that, there is a entity level controls, which is operated at an entity level. It includes control environment, risk assessment, and monitoring, and information and communication. Now, control environment is such that what are the ethics or code of ethics, what are the uh, means by which they ensure at a senior management that the ethical values of the company are maintained, how it is communicated to the employees, if there are any issues, is there any situation where they have come up with a reaction or a remediation, or they were required to remediate. So very important, you should understand this. So yeah, this is the part of control environment where you have to see how company is communicating the ethical values. You should also see how the company has designed the segregation of duties amongst the people who are doing it. Like if if there is a purchase process, there should be proper segregation between who is preparing the purchase order and who is doing the payment to the vendor. So it can be same person. So that control has to be performed at a high level by the senior management, that who is authorized to do what. So this is very important. You should also see what are the HR policies and practices of the company, how those policies are consistently applied. We should also see organizational structure of the company, how the reporting hierarchies have been established by the company, so that uh, nothing gets faulted there. How the management reacts, what is the discipline they are following in the control environment. Are they positive about changes, are they positive about following a particular control, what is the commitment to competency. So are they tolerating the incompetencies. So if person is not capable of doing it, not competent enough to perform certain controlled activities, uh, whether they are bringing some change in that process, or they are tolerating the incompetencies. This is what we should check at an entity level control environment. We should also see how the people with those charged with governance participate in the risk assessment. So in control environment at an entity level, how do they obtain the internal audit function reports, how do they ensure related parties are at arm's length, all the transaction with related parties are at arm's length. So this kind of understanding will help that at a senior management level, how really the entity is focusing on the control. Is the control environment really satisfactory? If the answer is yes, then you will be able to follow your process level controls, your substantive procedure very smoothly. And by having an effective control environment, it reduces the substantive procedure significantly. So following control, and in an IFC environment, it is now mandatory only. However, understanding of entity level control is something that is required to be done for all entities, irrespective of IFC is applicable or not applicable. Because understanding of entity level controls are part of the risk assessment procedure, not driven by any guidance note on IFC, because IFC talks about entity level controls. Even if IFC is not applicable, still you have to understand the entity level controls. Yeah. So we discuss about business process. It's about purchase, sale, distribute an entity's products, recording the information, compliance with the laws and regulation applicable. We also discussed on uh, ceramic activities. So this ceramic is basically control environment, risk assessment, monitoring, and information and communication. So this kind of ceramic activities apply at a entity level. Yeah. So we discuss about control environment. Then there is a risk assessment uh, related controls that we should see at an entity level control. So there we need to see how company is analyzing the risk applicable to the company. How, what are the controls they have put in place to mitigate those risks? How they are internally or externally assessing, what are the materiality they are applying at a company level to achieve their objectives and mitigate or lower down the risk. This will really help in understanding that how high level management really do risk assessment for the entity and what are the risks they see. So this can definitely help us in doing a proper risk identification for our audit. Monitoring, now this is also quite crucial. So what is the culture developed by the company to monitor the controls? Now there will be process level, transaction level controls that would be happening at a process level. Are there any controls which are operating at a high level wherein company's management reviews the overall situation, like are they ensuring bank reconciliations are happening on a timely basis? Are they having any mechanism of some exception report to generate, which can give a broader view idea about multiple captions that how company has performed or whether the controls are operating as designed? So this monitoring culture of the company, monitoring part, should also be seen as a part of understanding of internal controls. And the last one is information and communication. So information includes how the information is obtained by the company from the system. How, what are the ERPs used by the company? Uh, are there general IT controls in place by the company? Whether you can test those general IT controls and rely on automated controls. Whether information obtained on the system is reliable, whatever logics have been incorporated in the uh, ERP system is sufficiently reliable or not. And then we have to see how as a high level management they ensure that the information gathered is complete and accurate, and when it is shared with external people like banks, other stakeholders, investors, how do they ensure that the data is accurate and submitted as there in the books? Yeah. Yeah. Yeah, this we discussed that we even for no controls reliance approach means no IFC is applicable. This entity level control understanding is important. We have to, so we have to understand all the controls applicable, and then also then we need to obtain evidence from the company about those being operating effectively or not. So we need to perform a design and implementation of such entity level controls. So within business process, there will be financial reporting process as well, which is very specific in nature. We should understand how company draws the financial statement from the trial balance, journal ledger to the ultimate financial statements and disclosures including. So there we should also understand what are the ways how they approve the journal entries or manual adjustment they are making in the systems. So this becomes a high risk area for us under SA 240, where we need to identify high risk journal entries like significant uh, adjustments or um, significant judgment adjustments or any post closing entries or material entries, how they are processed and who approves such journal entries, whether there is a sufficient backup around this. Understand the period and financial reporting process as well. So how they ensure the closing activities are performed properly. Is there a checklist maintained by the company? How do they ensure each and every regulation, all the accounting standards, all the reporting framework is complied by the company, so that this can help in developing the controls more strongly in the file. Yeah. So understanding of controls of the entity at a smaller level is also very important. Although there can not be sufficient documents available, however, uh, since it's a single owner company, I'm sure a smaller entity will be single owner company. They will be having a better control than many large company. The only risk there lies is wherever they have to apply their own mind judgment, there won't be any discussion or challenge. That's where we should spend maximum time in such a smaller entity consideration. We should educate more and more to the smaller entity owners that they should maintain certain documents for our documentation, that whatever controls they are operating at a single owner level should also reflect in terms of evidences. Okay, so this is about once we have identified the risk, we have to assess whether it is at a financial statement level or at an account balance assertion level, whether it is during the year, at the year end, or presentation related disclosure. At the financial statement level, risk can be like the going concern risk, uh, the risk relating to, so company is into tax evasion situation. This can impact multiple account balances. So in that situation, the risk can be at a financial statement level. We discuss about going concern because if there is a significant doubt of entities to continue as a going concern, then you might have a situation of accounting all the account balances at a net realizable value. Um, then at an assertion level, as you can see in the slide, there can be occurrence, completeness, accuracy, cutoff, classification risk. At the year end, it can be existence, rights, obligation, valuation, etc. Presentation also will have same risk as the during the year and at the year end, because it will include both the things. I mean, the classification will be quite important. That will be something which is added as compared to during the year and at the year end assertion level risk. Okay, now we'll talk about significant risk. What are the special aspect of risk which requires special audit consideration? Depends upon the auditor's judgment and the factors that has been provided in SA 315. So there are 7 factors given in SA 315, wherein if there is a risk of fraud, transactions are very complex, or there is a significant economic or accounting development, or significant related party transactions which are outside the normal course of business, there is a high degree of subjectivity in a particular risk of error or fraud, then significant unusual transactions. Now, risk of fraud basically includes SA 240 related risk of frauds, which are presumed risk of fraud. That has to be first of all considered as a significant risk. There are situations where you can rebut also, but in a profit oriented entity, it's very high likely that you will not be able to rebut the fraud risk on revenue. However, that guidance is available if there are very good entity level controls, inherent risk is not significant, very simple company or selling to one customer or not many. There can be situation of rebutting the risk of fraud on revenue. However, it is more likely that you will end up in a situation where you will conclude the fraud risk on revenue is present, cannot be rebutted. There can be complex transactions like derivative. There can be uh, accounting for acquisitions, uh, impairment. All this situation can create a complexity because these are not the usual or simple ones which really is applicable to all the entities. Significant related party transactions, really this should be focus area because a lot of frauds have happened in this area, and arm's length over related party transaction is quite important to look at it, whether all the related parties are identified, disclosed to you as a part of the audit. There are a lot of reporting requirements also which has come in CARO 2020, wherein related party transactions have been given significant focus. There are a lot of changes happening in the SEBI regulation. Those all also require a lot of more approvals than what was earlier regulation in SEBI. Transactions which are outside normal course of business, so perhaps something which company is not doing it and there is a transaction, you need to be careful. Degree of subjectivity in an impairment of intangibles or investments, there are highly complex assumptions applied, highly complex projections or growth rates will be applied, and a lot of subjectivity might be there in the assumptions applied. So in those scenarios, you need to give a special consideration because this all things can lead to a significant risk. And unusual transaction, if company has shut down the operation of the company or shut down the operation of a particular business or has acquired a new entity, then it's not a routine transaction that happens every year. Rather, you need to give a special consideration over there. Now, what is the significant risk then? So, in listed companies, there is a section called in the reporting key audit matters. There, we actually uh, detail out why it's a CAM, what is the significant risk, why it is a significant risk, what are the steps auditor has performed to mitigate the risk and bring it to the low level. We define that in the audit report. Although CAM is not applicable to unlisted companies, however, that gives a very good definition, like what is the most important area of the company, where the engagement team is going to spend maximum time in the audit. Those will be the key audit matters. So, what is the quantum of the account balance? So, what will be the focus of high senior management to inflate or to uh, achieve more targets? So, this really helps us to identify the significant risk properly, and then there are set of procedures which we have to do as compared to what we do on a normal risk. So there can be a risk of material misstatement, and this risk of material misstatement can be significant risk also. But the significant risk requires more procedures to be performed. Special audit consideration is required than what you are doing usually. We'll talk about what all additional procedures we should do. I have listed down some of the procedures which can be useful for you to kind of read and apply it in your engagements. Yeah. So, yeah, in significant risk, what all things you should consider while identifying a significant risk? What does management identify as key risk and judgment in their business? How do these affect the financial statement? What changes has business encountered during the year? What relevant matters are identified during risk assessment? Consider those findings and other risk assessment procedures. In the prior audit experience, what were the account balances or judgments which were really complex? And at the beginning of the new year, you now know this is really complex and really need a focus more. And last one, as we discussed for the CAM, where does the team expect to spend the most time? Where do senior resources expect to exercise most judgment? So where do our partners will be focusing? Where do uh, our team has to focus more? So this areas require special audit considerations. There's a case study. Company is a listed entity and prepare its financial statement under Ind AS. Company A has a JV entity where it holds 50% of the shares. Balance 50% are held by a foreign entity. Uh, Company wants to acquire the balance 50%, whether and the amount value is 50 crores. Materiality is 10 crore applicable for the entity. So, is this a significant unusual non-routine transaction? Answer is yes. Is this a significant risk? Yes, because see, the amount wise it is 5 times the materiality, and it's an acquisition. It's not a usual transaction which company enters every year, and once they acquire the balance 50%, it involves a valuation of business assets, liabilities. There will be goodwill. So this becomes quite complex, non-routine in nature. Therefore, we should conclude this as a significant risk. Yeah, there are further more example on how can the significant risk be on the estimates. There may be a potential impairment of trade receivables for reversal of impairment arising from the measurement of expected credit loss. The preparation of estimate of impairment, including the calculation of ECL, assessment of significant increase in credit risk and other related matters, involves subjective judgments and uncertainties, which require special audit consideration. So here, what are the factors we have considered? It is seen that high receivable to sales ratio is present as compared to prior years or entities peers. Whether there are significant changes in the credit terms, whether there is an increasing or delinquency or slowing payments from the customer. These are the factors which you should apply mind, whether this can be significant risk on estimate, this can lead to a significant misstatement in the financial statement or not. There are litigations also. The preparation of estimate of provision involves subjective judgments. If the litigation are very complex, not there are no precedents available, such litigations require more careful evaluation of whether there is a high likelihood of outflow against this litigation, or there is a remote or possible outflow, because this will eventually lead to a situation whether we should show it as a contingent liability, whether we should not do anything, or we should make a provision for such litigation. So in such cases, we need to consider what are the legal regulatory requirements that may result in new obligation for the entity. Instances of failure to comply with the laws and regulation during the past or current period. This also helps to conclude us that this particular risk is a significant risk on estimate or not. Warranty provision also can lead to a significant risk. It is not necessary that all the estimates can lead to a significant risk, but yeah, the if the assumptions involved or the judgments involved surrounded by very high uncertainties, and the exposure of 1% change or 0.5% change can also be very very material, we should evaluate from a significant risk point of view. So what are the factors you should keep in mind, like changes in technology, production process, or demand for the products, changes to warranty terms from previous periods, any introduction of new products, inconsistencies in how entity applies the warranty policies in the different regions of the company where they are operating, which contains provision relating to warranty provision, and number and nature of customer specific rather than standard. So sales contracts that are used. So we should see all these things. Yeah. So we are now at the risk assessment and planning discussion stage. We discussed about entity and its environment. We discussed about planning analytical procedures. We discussed about inquiry with management, TCWG, others, internal audit function, reading of board meeting, audit committee meeting. Then we discussed about understanding of the internal control environment, and we also discussed about significant risk. Yeah. Now, after doing all this risk assessment procedures, it is very important to hold a risk assessment and planning discussion amongst your engagement team, wherein you will discuss about all the information you have gathered in a summarized manner to say these are the risk applicable to the company, these are the risk linked to the account balance and assertion level, and discuss about the potential planning about how we will mitigate those risks, how what are procedures we will plan to reduce the low risk to low level. Here the engagement partner, uh, quality control partner applicable to the company, to the engagement, all the team members, or if there are any experts involved, those experts should also be kept in such discussion. They should be hold well before executing the audit, at our very planning stage after doing risk assessment procedure, but before executing the audit plan. So yeah, in this meeting also, one thing need to be a key message to all the team members will be, you have to make people aware that professional skepticism is something which they have to keep in mind every time. You need to have a questioning mind. Don't rely on the face what client says. It's very important you question, you do a corroborative check on whatever evidences are provided by the company. Also discuss if there are any changes or significant accounting principles which is applicable for a year, and obviously you need to specifically discuss about the significant risk you have identified and what will be the potential audit responses to such significant risk. We discuss about that we engagement partner shares the experience, even the other team members also, quality partner will share their experiences if they have handled particular risk or particular entity, they will be able to share and provide some aspects and references. So having such meeting is quite advisable, and not only for the large corporates, it is important that even for a small entity it can be a 15 minutes or 20 minutes discussion, but before executing the audit it's quite important you you accumulate together and discuss about the most significant risk, how will you tackle, how will you focus more on the documentation, what are the regulatory reviews really applicable, what is the focus of the regulatory reviews, Should we improvise in those documentation based on the best practice you would have heard from your fellow colleagues? Yeah, this we discussed. When does the RAPD occur? It is after obtaining the understanding of the entity and its environment, including understanding of internal control, but before the team starts designing and executing the remainder of the audit plan. Yeah. At the risk assessment and planning discussion, this is also very important, which we should discuss. This is relating to fraud risk assessment on revenue. We should quite in detail understand entire compensation arrangement for the senior employees of the company, senior management of the company. What are the variable bonus, fixed bonus applicable to the company? How this variable bonus is linked to entity's performance? Is it like 90% of the bonus is dependent upon if company is achieving 100% of their targets? Then it creates a fraud risk that senior management can go for. If they are not able to meet the targets, then they might go and try to manipulate the revenues uh, to show more profits, to meet the expectations of the uh, stakeholders of the company. Also, we should see any compensation arrangement is linked to a stock option. So if any stock options are given, or is it given in a compensation arrangement that you will get X amount of stock if the performer company performs like this. So this really can be leading to a fraud risk on revenue that company, the senior management may try and do maximum to achieve their targets. These are the conditions and event that may indicate risk of material misstatements. Appendix B of SA 315 includes all these condition and events. So we have largely discussed most of the things, but this is just a summary of what is given in the SA 315. Okay. now we'll be on the SA 330, which is responses to assess this. So we have identified and assessed the risk. Now, what will be our audit response to such assessed risk? Why do we need to do that? So why we design the audit procedure? We discussed on the first slide that ultimate objective is to reduce the risk to the low level. Okay, whatever risk of material misstatement we have identified, how best we can reduce it to the lowest level. What do we have to do that? We have to obtain sufficient appropriate audit evidence. Okay, how we can do that? By following a no controls approach or a substantive testing. So controls and substantive testing in an IFC environment can help you to build up a situation where you have sufficient appropriate audit evidence. Where IFC is not applicable, directly do substantive approach, substantive testing, full procedures are performed, and there because you are not relying on the controls approach, you have to do significant sample testing to obtain sufficient appropriate audit evidence. To obtain necessary level of audit evidence, it is important that you vary the nature, timing, and extent of audit procedures properly. So, and if the audit risk is very high, then obviously more persuasive audit evidence is needed. So, more persuasive audit evidence means more reliable, like external confirmation, external evidences, or doing 100% test of a transaction. That gives a more persuasive audit evidence. So these are the definition of nature, timing, and extent. What is the nature? Nature means uh, the type of procedure you perform. Is it a substantive analytical procedure, test of details, which includes the inspection, external confirmation, or recalculation or reperformance? When you obtain the evidence, so timing is about when you really obtain the evidence. What will be the time period? Is it a interim date? So if you are having a deadline for the company to report by 30th April, and you have to perform your procedures on trade receivables confirmations, in that situation, it's going to be quite challenging if you do the confirmation procedures on 31st of March. It is because you will get the information from the client, I mean the customer list from the company by 10th or 12th. In that situation, it will be very less time for the customers also to send the responses to our confirmation request. So in such situation, standard allows to do the procedures more nearer to the reporting period end, which is March, and you can do a procedure on February numbers. And then for the selected samples, you can do a roll forward procedure just to check there is no significant movement, and whatever movements are there, you have appropriately covered in your roll forward procedure. Same way for test of controls also, this is available, and there also you can do a roll forward testing and complete your control testing part. Extent is something how extensively you perform a procedure, or what quality of items subject to testing. So is it a situation where you can test 100% of the population, like power and fuel expense, or power expense, electricity expense? There are 12 bills in a year. Are you able to check all 10, 12? Then do 100%, wherever 100% of the items can be tested. Wherever it is not compulsory that you need to do 100%. There is a sampling possible, but those sampling is possible when you have a large population in place. But the population is small, then you should go for a specific item testing, or maybe 80%, 90% coverage, or 100% of the coverage at least. Yeah. So types of audit response to address risk of material misstatement. Engagement teams need to design and perform audit procedures to obtain sufficient appropriate audit evidence. So control reliance approach and no control reliance approach we discussed. We need to identify the what could go wrong in controls and evaluate the design and implementation of the controls, test operating effectiveness of control, and substantive testing. If it's a no controls approach, you still have to do a design and implementation of control in a significant risk areas. So in a non-significant risk area, no controls approach, only do substantive testing. But in some certain circumstances, which is like a significant risk area, there you need to at least identify what could go wrong and controls and evaluate the design and implementation of the controls. As you can see in the middle, significant risk, DNI of relevant controls is evaluated during risk assessment, even if engagement team does not rely on controls to address the RMS. Why do we perform substantive procedures? So to test whether each significant account or disclosure conforms with the applicable financial reporting framework. So ultimate objective will be what? All the risk arises from whatever risk is applicable to the company. It will be due to requirement of the accounting standard or Ind AS as applicable financial reporting framework. So you have to link all those things, and all the risk we have to link it to accounting standard procedures, and then we need to perform a substantive procedure as designed by us. These are the types of substantive procedure we discussed earlier, that substantive analytical procedures and test of details are something which is required. And so analytical procedure includes predictive analysis, trend analysis, data analysis, ratio analysis. So I'll give you some example of analytical procedure. For a payroll, you can develop an expectation basis last year payouts by doing a comparison that what was the payroll expense for the year last year, what was the number of average number of employees last year, what is the per employee salary, add up company's announced increment for the year. By doing that, you can develop an expectation that how much could have been the payroll expense, and then you compare with the actual payroll expense in the financials. If the difference is within the acceptable limits, then you can very well do nothing other than doing only substantive analytical procedure. There are cases where provision for expenses, you can also check that what is the inflation rate applicable for the company. If it matches and there is no significant difference, then you can very well rely on this procedure. But yeah, from a completeness point of view, you still need to do uh, period 13 kind of procedure by testing subsequent period expenses, that all the expenses have been captured in provision for expense. You, as a part of test of details, as we discussed, first you should always see whether you can test all the items of account balance or not. If not, then go for a specific item. Specific item should determine in such a way that whatever you are not testing should not be very material. It should be less than your acceptable limits. Then do follow a sampling approach. Like sales, you have lakhs of transaction every 5 days or 10 days. In such scenario, it's impossible to do 100% testing or specific item testing. You have to do a sampling as a specific standard on sampling, where you can follow some of the statistical methods of sampling, and can be useful to draw a sample in a systematic way rather than just selecting top 10 or top 20 kind of a thing. It's better to use a statistical tool to draw the sample, which will not be questioned during the regulatory reviews. It will be unbiased in nature because the tool will throw the number of samples. You won't be selecting, or you won't have any bias to select the sample. This we discussed. For significant risk needs to be identified in two types. What is the risk of error? Is it a risk of error or risk of fraud? And if it's a risk of fraud, at a assertion level, you have to perform substantive procedures, which will come in the subsequent slide. And if it's a risk of fraud at a financial statement level, then we need to have appropriate people on the engagement, consider the appropriateness of accounting policies, perform unpredictable procedures. We'll discuss about that. Apply more professional skepticism if it's a fraud risk due to financial statement level risk. Yeah, so this is the broad summary. If there is an inherent risk assessed as significant, question that did we perform the test of controls? If yes, then did we determine that controls are operating effectively? Then perform the substantive procedure in response to significant risk. If we have not performed the control testing, I mean the test of operating effectiveness of the control, then you can directly perform substantive procedures. So here the term used is test of operating effectiveness. So DNI of controls is mandatory, as we discussed earlier, but at least if we have to assess whether we have relied on test of controls or not, because if IFC is applicable, definitely we would have tested the operating effectiveness of control for all account balances, all the significant account balances. Okay. Now, these are the substantive testing procedures which can be applied in response to a significant risk. So, as you can read, first is observing inventory locations where our attendance was not previously announced. So, if there are multi-location where companies' inventories are lying, and we have not attended particular inventory location, then we can observe our inventory location for physical verification without announcing and doing a surprise visit to that location. We can do this procedure just to see the things are all right even at that location. Detailed review of entities quarter end or year end journal entries. What are the adjustments they are making at the period end? Are those significant? What was the first cut trial balance given to you, and what is the subsequent trial balance given? What are the difference in which account balances? Try to do those kind of procedures just to be little more smart to, during your audit execution. Uh, Confirming with customers relevant terms in absence of side agreement. So we send out the confirmation for the customer balances. However, put additional things like what are the terms, what was the credit period written in the company's communication with us, and what is confirmed by customer. Is there any side agreement involving experts to validate critical management estimates? So this can help in reducing the risk significantly, because those expert, like people having valuation expertise for impairment calculation, can really help us, whether the projections, whether the assumptions made, the discount rate used in the impairment calculation is really reasonable. Can we rely on such judgments made by the management? Retrospectively review some of the management judgments and assumptions applied in prior periods. You can also seek oral confirmation from customers and suppliers in addition to sending written confirmation, because sometimes confirmation requests are not responded all the time. So we can also do and apply, or because you will have some contact information on the customer website or something, try to do an oral confirmation just to check whether the customer really exists, supplier really exists. uh, you can also do a vendor list check wherein you can match the address or phone number. Are there any matches between the vendor list and list of employees, or the PAN details or PAN numbers? If something is matching, it should not be the situation, because vendor cannot be employee or employee cannot be vendor, or it should not be at both the places at least. Also seek additional evidences from outside entity, like background checks you can do on your own for the vendors, customers, for the perusal of publicly available information. In the payroll also, you can see identify duplicate addresses or employee identification or taxing authority numbers, or any bank account numbers are quite similar. These kind of procedure can help you in deciding or designing some more procedure than what you usually do in a significant risk area. Okay. Now, this is perhaps the last slide. Uh, so, some of you may be aware that ISR 315 has been revised. So, we are talking about ISR 3, International Standard on Auditing. So this is applicable for financial years ending after 15 December 21. So for March 22, it is really applicable for the firms who are actually following ISA uh, at a higher level. So there still SA 315 is not revised. So it was written in 2008. It is under process to get revised in line with ISA 315. However, I'll just brief you about the some of the key changes that is being brought in ISA 315, which may become applicable for Indian context in the coming time. So they have allowed the use of automated tools and techniques in risk assessment procedures, because considering the current environment, since the old standard was issued in 2008, there was a real need of revision in the context of current economic environment. So they have so you can still use those automated tools and techniques in risk assessment, but there was no specific mention in SA 315. Now there is a specific mention in ISA 315 revised. There is an enhanced auditor consideration on use of IT and its impact audit. So currently also there is a required consideration on use of IT and its impact, but this is more robust and more stringent requirement to consider in a more detailed manner. Importance of entities control environment has been enhanced, and how this is a foundation for entities system of internal control is really explained. They have introduced some of the specific requirements of the general IT controls and IT processing controls. In ISA 315, there is an increased focus on the documentation around professional skepticism, including any corroborative evidence you have obtained, then which is contradicting with the management representations or management what management is saying, and you have a contradictory corroborating evidence, then what all documentation need to be in place. That this new standard has focused upon. Also, they have introduced the requirement of stand back once risk assessment procedures have been performed. So, as you know, risk assessment procedure is quite iterative process, dynamic throughout the period from the beginning to the audit conclusion of audit. This risk assessment procedure need to be performed. There is a need to have a stand back work paper saying whatever risk you applied initially holds good towards the end of the audit or not. If not, if there are changes, what are those changes? How you have mitigated those additional identification of the risk? Okay. Uh, thank you. I am little late by 5 minutes. Uh, thank you for hearing me, and we can open the line for question and answer.
Thank you, sir. Thank you so much for such a detailed and wonderful deliberation. Can you hear me, sir?
Yes, sir. Yes, thank you.
Lekin, sir, it was really very marvelous deliberation, very detailed and in a very lucid manner. You have touched all the factors relating to the risk assessment and all, and you have covered all the important topics as well as covering the SA 315 and 330. You have covered all the things. And actually, there is some technical problem today in Delhi. So in initial, I have received only one question, but now until now I haven't received any because of the technical issue. But what I will do whenever I will receive the question, then I will forward to you. Then your responses I will forward to the member. So the question I have received, I am discussing with you only one question. There is one query regarding turnover in respect of commission income on sale and purchase of discount on gift coupons. I am repeating, regarding turnover in respect of commission income on sale and purchase of discount on gift coupons. In this situation, what is turnover? Either total discount received on purchase of coupon or net benefit, that is total discount received on purchase of coupon minus total discount paid on sale of coupon.
Anil ji, I have not got the question correctly actually. And is it relating to the risk assessment?
No, it is. I am
Auditing
also
standard?
wondering. It is not relating to this. It is a general query. So I said to in the beginning I have received. So I thought in your any of your presentation part, maybe in an example, it was covered with you. But I don't think so. It is relevant. But still, I will forward it to you, and
Yeah,
I
yeah.
will seek your expert comments
You
on
can
this.
share with me. I'm happy to help on this offline.
Yes,
But
yes, yes, yes,
I
yes,
feel
yes.
that this is not relating to risk assessment procedures.
Yes, sir. Yes, sir. Yes, sir. Yes, sir. Yes, sir. So, sir, on behalf of AASP of ICI, I extend my heartiest thanks towards you for sparing your valuable time and acceding to our request on a very short notice, as well as enlightening all of us on various intricacies on SA 315 and 330. It was wonderful to have you on this virtual platform, sir, and we gained a lot through your expert knowledge, and I hope our members have also gained on various practical aspects we have shared with you on this risk assessment. Thank you so much, sir. Thank you so much.
Thank you, Aniji. Thank you, Sushil ji, and Sanjeev ji. Thank you
Thank you,
for
sir.
giving me this opportunity. Thank you.
Thank you, sir. Namaste.